All right. Good afternoon, everyone. Thank you for dropping by. Today's topic is tax considerations for non-resident real estate investors. This should be a very interesting topic for a lot of realtors who have a lot of non-resident clients. My name is David Wu. I'm a chartered professional accountant. My areas of focus is real estate tax, retirement income planning, and financial risk management. I would like to, before I get started, talk about my Realtor Alliance program. So I offer free tax consultation for realtors and their clients. Okay, so initial consultation will be free. Please send me an email of your question, and I can schedule a call with you or give you a reply for email. If you're a brokerage, I offer free tax seminars for brokerages, so please reach out if you want me to do some training for your realtors and your agents. My contact information is outlined on the screen, and please feel free to reach out for more details about my Realtor Alliance program. Okay, now let's get to the topic of the day, tax considerations for non-resident investors. So non-residents are people who don't live in Canada, but they're buying real estate in Canada. So let's look at first of all, if you're in Ontario, okay, we have a 15% non-resident speculation tax. So this applies to foreign individuals and corporations who purchase residential property in the Golden Horseshoe region, the Greater Golden Horseshoe region. So if you are a non-resident, you right off the bat needs to pay an extra 15% premium on the property that you're purchasing. Now, if you're a Canadian citizen or a permanent resident, even though that you might be a non-resident uh, today because you left Canada, you would be excluded from this 15% non-resident speculation tax. So this non-resident speculation tax is purely for people who are foreign individuals, have no Canadian citizenship or permanent resident status. Okay? Um, if you're buying a property with multiple owners and one of them is subject to this speculation tax, then 100% of the cost is subject to the non-resident speculation tax. So there's no proration based on the number of owners. Okay? There is an exemption that if your spouse is a Canadian citizen and they use the property as their principal resident, okay, you can be exempt from the non-resident speculation tax. Okay, so if you have a spouse who is buying the property with you and the property is their principal resident, then you are okay. Uh, Another exemption, if you have a refugee status at the time of the purchase, you do not need to pay the non-resident speculation tax. So some more information on non-resident speculation taxes. If you pay this tax, you could qualify later on for a rebate of the full 15%. Okay, so there's three scenarios that can happen. So number one is the foreign buyer becomes a permanent resident within 4 years of the date of closing. If you are a foreign buyer and you become a permanent resident, you can apply within 90 days of becoming a permanent resident to get back your full 15%. Okay, so there's an application form for this rebate that you can apply for. So that's number one, if you're a foreign buyer that becomes a non permanent resident. If you're an international student enrolled in full-time education in Ontario, so it needs to be in the province of Ontario for at least 2 years continuously since the date of closing, you have 4 years to apply to get the 15% non-resident speculation tax rebate. Okay, so international student, full-time education in Ontario, at least 2-year program since date of closing. Lastly, if you are a foreigner with a work permit, and it needs to be full-time, minimum 30 hours a week, in Ontario for continuous 1-year period since the day of closing, you have 4 years to apply for this 50% rebate. Okay, so go back to any of your clients who may have paid this 15%, see if they qualify for this rebate, and if so, make sure they apply to get their money back. Okay, so the next topic is on non-resident buying rental property. So how it works is if you're a non-resident of Canada, okay, there is a withholding tax based on gross monthly rent that you must collect and remit to the government of Canada. So every month you'll need to take 50% of your gross rent and remit that to the Canadian government. At the end of the year, you'll do a reconciliation of your net rent subject to taxes compared to how much withholding taxes you have paid already and claim a refund accordingly. Okay. I I would like to mention that there is a special election that you can file to reduce the withholding taxes from 25% of gross rent to 25% of your net rent. Now, the difference between gross and net rent is net rent, you get to claim your rental expenses. So net rent is a lower number than your gross rent. And as such, 25% the lower number will result in you paying less of a withholding tax. So that's a special election that I can help your clients with to complete. So think of the 25% amount. If you're non-resident, 25% needs to be paid as a withholding tax on your rental income. Okay, so it is beneficial to file a Canadian tax return to claim the refund back at the end of the year. Now, what if you're a non-resident and you're selling property? There's a need to complete some additional paperwork and request something called a certificate of compliance from the CRA. In order to get the certificate of compliance, you'll need to tell the CRA how much was the capital gain, and you'll have to remit a withholding tax to the CRA. Okay, so again, it's 25%. Now, here's the difference here. If you do this paperwork and you remit it before the date of closing, so you're doing this in advance, it's the amount you have to remit is 25% of your capital gain. If you wait till after closing, then your lawyer will need to withhold 25% of your selling price, of the sales price, which is a lot higher than the capital gain. So a lot more money is going to go to the lawyer's trust account. You still need to do the request of the certificate of compliance, and you still need to remit the money to CRA before you can get the certificate of compliance. So you can either pay using your own funds or see if the lawyer can release some of the trust money for you to pay for the CRA. Okay. Then again, when you file your tax return at the end of the year, you will be able to get your refund. Okay. If you wait till after closing, 25% of your selling price gets withheld into a lawyer's trust account. As soon as you receive your certificate of compliance, the lawyer will then release that the balance that's in the trust account. Okay, so you don't have to wait till the end of the year to get that money. However, once you do your tax return, you can definitely get a refund back. So it's beneficiary as a non-resident to file a tax return. So having said that, you need to be careful of buying from a non-resident, because if that non-resident does not pay the 25% withholding, or the lawyer does not do the withholding, and the CRA does not get its money, you as the new buyer will be on the hook for that money. So it's very important to hire professionals who knows what they're doing, so that you can avoid situations like what I just mentioned. Okay, so I hope that gives you a quick overview of non-resident tax relating to real estate. Again, I have a Realtor Alliance program you can join. It's a program geared towards realtors where you can have free tax consultations for realtors and your clients, as well as free tax seminars for your brokers. So my number and email is indicated on the slide. So please take a moment and copy it down, and I look to speaking to you in the future. So hope everyone has a wonderful day, and I will talk to you in our next video.